Okay, well, good evening and welcome, everyone. Thank you so much for joining us. We are very excited to share with you our halftime report, the mid-year review and outlook, and lots of information to cover. And we are going to jump right in as we speak. So some of you may already know this, but we do record these presentations. We will send a replay, which will include all of the slides that you can download for future reference. The presentation itself is about 45 minutes-ish, plus or minus, and then we will have time for Q&A at the end. As you can see from this next slide, if you do have a question, we ask that you type your question in the Q&A box. You will see the Q&A icon at the bottom of the screen. And that way you'll be able to ask a question. We will get to all the questions, as many as we can, at the end of our presentation. Okay, important disclosure information. You're probably very familiar with that. We have another page of important disclosure information as well. Okay, so now let's talk about your three wealth management advisors. This is the Dechtman crew, the A-team. Myself, of course. Sam is on the presentation here tonight. And also one of our other esteemed advisors, Adam Dechtman. All of us are here to help you and to answer any questions, and anything you might need, we're always available. We couldn't do what we do without our fantastic team, and this is the crew that makes us look good. We are so proud of the Dechtman Wealth Management team. The tenure of our staff is going on almost 20 years per person, and I just couldn't be prouder of our entire staff. And anyone that's had any kind of dealings with them knows that they are top-notch, second to none. So our hats go off, and we appreciate them. So let's jump into the agenda here. Sam is going to be doing the meat and potatoes of the presentation. I will come back at the very end and kind of wrap things up. But Sam's going to be talking about inflation, one of the #1 concerns, and what you can expect going forward. Interest rates, global economic outlook, recession is a big question we're hearing a lot about. And then at the end, we're going to give you what we like to call the 5-star tips. These are investing principles and strategies. This will tie it all together, and you don't want to miss that last part. They are some excellent, excellent strategies, and I'll touch on those at the very end. That being said, turn this over to Sam.
All right. Thank you for that introduction, Jordan. And in addition to what he was saying, we're going to be going over the good, the bad, and the ugly, except we'll be doing it in reverse order because we'll be talking about inflation right at the beginning. At the end, I will summarize the main takeaways from our presentation, and then Jordan will round it out with giving you actionable ideas on how we can try and make lemonade from the lemons we've been given. So let's now get into inflation. Inflation has been high for an extended period of time now, over a year, but it actually accelerated to 9.1% in June, which is a pace we have not seen in over 4 decades, which is adding pressure on the Federal Reserve to act more aggressively to slow the rapid price increases throughout the economy. We saw a big jump in gasoline, which is up 11.2% from the previous month and nearly 60% from a year earlier, while shelter and food prices are also major contributors. While headline inflation is 9.1%, We also saw core prices increase by 5.9% in June, which is slightly less than we saw the 6% increase in May. So right now we are at a peak inflation that we haven't seen in a very long time. So let's jump into some historical parameters, and then we're going to get into what we would expect going forward. So what we're looking at here is a chart which goes back all the way until the 70s. And the light blue line that you're seeing going across the screen is what is called headline CPI. And think about this as inflation that encapsulates everything. And the thicker gray line that you're seeing move not quite in tandem with the light blue line is core CPI. Now, core CPI includes everything except for food and energy. Now, core CPI has excluded food and energy for a very long period of time. This is not a recent phenomena given what's been going on with the pandemic as well as the war. And so to give you some context, we can see the 50-year average for headline CPI is 4%, and the 50-year average for core CPI is 3.9%. So the latest figures that this gave was from May, which was a little bit less than what I just said in June. The headline was 9.1 in June, and the core and CPI was actually 5.9. So we're certainly higher than we've been on the 50-year average, which is really what's been prompting the Federal Reserve to aggressively raise interest rates. And so the core is up as well, and that is your regular goods that you're purchasing on a daily basis beyond food and energy. Every type of household good primarily has been up, since the start of the pandemic, mostly. So one other thing that's important that I wanted to mention on this chart is that housing inflation represents about 40% of core CPI. And we saw record home prices and higher mortgage rates in May made it one of the most expensive months since 2006 to buy a home. Those conditions are leading prospective buyers to drop out of the market for now, but with limited supply and continued demand, it may take months before housing prices see significant declines. So that's one thing that we'll be keeping an eye on in terms of core CPI and its relation to home prices going forward. So now what we're going to be talking about is the inflation equation and trying to understand how we got here, why the Federal Reserve is raising interest rates to try and tackle this, and what we think, could be coming ahead. And there's a chart after this one which will sort of paint that picture for us. But at its core, inflation is caused when the money supply in an economy grows at a faster rate than the economy's ability to produce goods and services. So now let's go over this equation. So M times V equals P times Q. M is the money supply in the economy. V is the velocity of money. And so those two multiplied by each other equals the overall price level of goods and services and the quantity of goods and services. So what had happened over the pandemic was we had trillions upon trillions of dollars thrust into the financial system, which means that the M part of this equation began to go up. And what we saw, at least early in the pandemic, was we were having huge issues in related to producing the quantity of goods and services. Now supply chains have slowly started to come back to producing goods and services to the level that is necessary, but the money supply is still too high, which is why we're seeing an equal increase primarily in the P. So as long as the M is increasing, that means that one of these two parts of this side of the equation must go up. And what we're dealing with now is the P, the overall price level that we're seeing from different goods in the economy. And we're going to get into the Q in a little bit when we talk about supply chains. But to kind of fast forward here, what we're looking at here is what's called the M2 money supply. So this is the M part of that equation. And you can look back all the way here on the left-hand side of the screen to where we were January 2020, and this reading ended up going all the way through May. And so money supply and inflation, as we know from the equation previously, are very highly correlated over time, which is why we're watching this M2 money supply very closely. And so what we're seeing here on the end is a small glimmer of hope as to what we hope the trend is going to look like. And it looks like we may have leveled off a few months ago in March. April, it went down pretty good, but then May is a slight tick back up. So we are supposed to be getting the reading for the M2 money supply as far as June is concerned this week. So we'll be keeping an eye on that, as well as keeping an eye on what is to come. And we are of the belief, and we are optimistic that most parts of inflation, most prices should start coming down as we see the money supply start to move in the right direction. Now, of course, things like energy and food, those are more dictated at the moment based on other geopolitical events, primarily sourced around the war. But the M2 money supply, again, this is the one glimmer of hope, if you will, that we're looking at right now in terms of when we think we might start to see inflation break. And really, this won't show up into the economy immediately. This is a lag in terms of when you will start to see this reflected in different prices, of goods. So now let's talk about interest rates. What we're looking at here is a chart of the federal funds rate going all the way back to the early 2000s to where we are today. And if we kind of scroll here, and look on the bottom right-hand corner towards the 2022, we'll see that the Federal Reserve has raised interest rates 3 times this year. One 25 basis point increase, which is 0.25%, one 50 basis point increase, which is 0.5%, and one 75 basis point increase, which is 0.75%. And in all likelihood, the Federal Reserve will raise interest rates another 75 basis points again this week, or possibly even 1%. The interest rate increase during this cycle is very large compared to past interest rate increases. But as you can see, we are still well below when interest rates were before the financial crisis, as well as the early 2000s. And I would be remiss if I didn't mention another component that the Federal Reserve is doing to try and tackle the economy. In addition to raising interest rates, the Federal Reserve is also selling bonds from its balance sheets. The intention is to cool the economy down and thus bring inflation down with it. So as we've talked about during past presentations, but it's important to just summarize why they're doing this and what the intention is. By increasing interest rates, what they are trying to do is they are trying to slow the economy down. But the Federal Reserve is doing its best to try and walk the tightrope, where they slow the economy down enough to really tackle the prices of goods, but not so much that we are going to tip into a recession. However, the Federal Reserve has come out with a very hawkish stance, saying that they are willing to do whatever it takes to tackle inflation, even if that means pushing the economy into a recession. And so we're going to see here pretty quickly how steadfast in their belief, the Federal Reserve truly is in tackling inflation, if we continue to see some increased turbulence, with the increase in interest rates here. As far as what we expect, again, the increase this week we expect to be about 0.75% or 75 basis points, if not 1%. And they're hopefully going to give some thought and feeling as to what future interest rate increases look like for the rest of the year. But our suspicion is they're going to be vague in that because they want to be data dependent. So we'll just have to see what the messaging looks like and what the future path of rate increases look like for the rest of this year. But the market is anticipating that at some point in 2023 that the Federal Reserve may have to cut interest rates, signaling that we may potentially be in a recession at that time. And so they'll need to ease economic conditions to, again, sort of drive demand. So now let's take a peek at the global economic outlook. And the first area we're going to start when we talk about the global economic outlook is the US. And what we're looking at here is a graph showing the labor market. And let's just say that jobs are plentiful. There are 1.9 jobs per every person looking for employment. As you can see in this graph going back to the early 70s, we are at one of the highest levels that we have ever seen. Employers, there's about 11 million job openings on the table. Now we've started to see some employers rescind job offers and we've started to see some layoffs. But at this moment, the economy is still adding net jobs. And so even in spite of the layoffs that we're seeing, the economy still has all of these job openings and is still adding people on a net basis. And so we think that this is a good undercurrent, meaning that businesses are clearly still trying to grow, still trying to expand, still trying to increase profits, and everyone is not necessarily in that cost-cutting mode like you see, some companies are beginning to take. So let's look at where we're at from an unemployment rate standpoint. And on this graph, you'll also see that that is intertwined with wage growth. So the unemployment rate is the thick gray line that is traversing across the screen. And the 50-year average for the unemployment rate is 6.2%. Now, an economy that is considered at full employment is somewhere around that 4-ish, maybe between 4 and 5%. Currently, we're at 3.6%, which is the lowest we've been, you can see here on the graph, for at least the past 50 years. And so folks that want to work and are finding that, there are good jobs available for them and continue to be employed. And so what employers have had to do to try and fight for these workers is they've had to increase benefits, whether that be, pay, adding on additional incentives, signing bonuses or other incentives related around the benefits that they're providing. So what we've seen in terms of wage growth, if you look here on the right-hand side, is we've started to see it tick up. And so this is also one of the components that is really on the minds of investors when it comes to assessing future profitability of companies. As we discussed, inflation has been very high and persistently high for an extended period of time, which means that it's more costly for companies to source the raw materials to manufacture their goods. And depending on where you're shipping it from, the cost of shipping it to the point of sale is more expensive. And now you have to pay more for the folks that are helping you, with all those operations. And so when you have the costs continue to increase, you need to be able to continue to raise prices. But eventually we'll get to a point where consumers are no longer, willing to just keep paying more and more and more for everything. We'll be getting into that, in just a moment. So in regards to what we've seen in terms of profits, I wanted to share one bit of positive news, as we've kind of begun the presentation by talking about some, ugly and bad signals. What we're looking at here is a graph of the S&P 500 quarterly dividend payouts over the past couple years. And I want to focus here on these two columns on the right-hand side. The first quarter of 2021, the companies within the S&P 500 set a record for most dividends paid ever. And they followed that up again with the second quarter of 2022, paid out more in dividends than at any point in history. Companies are only able to pay out dividends if that means that their cash flow is strong and that they continue to remain profitable. So while there is a lot of headwinds, at the moment, companies are still doing well, clearly enough to want to, pay out more than they ever have in history. So I wanted to give you that, tidbit, because at the moment, not all is doom and gloom. And so moving outside of the United States, here's some headlines that you might have seen from around the world. UK inflation hits new 40-year high of 9.4%. And so in order to try and tackle not only the UK inflation, but also inflation is pretty significantly high in Europe as well. The ECB, which is the European Central Bank, increased its key interest rate by 50 basis points, which is 0.5%. So it is now at zero. Their interest rates have been negative since 2014, and they plan to raise rates more throughout the rest of the year. Europe is also struggling to cope with the war in Russia and Ukraine as it charts its path forward on what it's going to do in terms of the energy situation. And as we're seeing here with the next headline, China's economic growth slows following COVID lockdowns. China continues to engage in a zero COVID policy that aims to isolate every person who tests positive. This is putting a lot of pressure on China's trading partners as the shipping and manufacturing disruptions continue. So for our clients in your portfolios, you've already seen us start to make changes which occurred at the beginning of this year, and in some cases the beginning of last year, where we have moved some monies that would have normally have been invested internationally back here to the United States. While the United States has gone through its struggles, we think that the obstacles that the rest of the world faces are likely greater. And when we look at past downturns, the other parts of the world generally have a more difficult time in terms of how long the duration of these down periods are, and they have not as robust of a bounce back as the United States. And so just wanted to point out that it is not only the United States dealing with these issues, it's everywhere. And given the one positive dynamic, which I went over in terms of dividends, in terms of US companies, we're going to talk about here some other positives, that lead us to believe that the United States, should be the best game in town for an extended period of time. So here's the question that many of you may be wondering. It's something you may have been reading about, seen on TV, but what is the recession probability? Can we expect one this year, next year, the year after? Where are we at? When is this going to happen? And what is the significance when and if we do encounter a recession? So what I wanted to show you here is this is a graph of the leading economic indicators. And the leading economic indicators is a predictive variable that anticipates turning points in the business cycle by around 7 months. And shaded areas denote recessionary periods or economic contractions. And so this goes all the way back until the early 2000s, up until some point this year. And so as you can see, and we're focused on this light blue line, the economy has never gone into a recession when the LEI has been increasing. So above this zero line. And so as you can see here on the right-hand part of the spectrum, we are getting dangerously close to that zero level. And so to answer the first question of, are we in a recession now? We do not believe so. And we don't believe so for a few different reasons. One, the profits of the companies in the S&P 500 were extremely robust in the first part of this year. There are 11 million job openings. The unemployment rate is at 3.6%, and none of those things smell, look, and feel like any past recession that we've encountered. But as we continue to see inflation, remain persistently high, and with the increase of interest rates, that might change. And so, as I kind of read, one of the key takeaways from this chart is that this is really good at looking out, multiple months in advance, 6, 7+ months in advance. And so if we are to tip negative, that doesn't necessarily mean that the economy moves into a recession, at that particular point in time. So one other thing that's very important to understand and appreciate is that a recession is just a mile marker on this marathon. When a recession is called, it does not change anything in terms of what is going on with current economic conditions. Recessions are always called in the past, and generally it takes 3 to 4 months after they've begun to initially signal that it has started. And so when or if a recession is called, that does not change the outlook on things. It really just has us look back and see, what has already occurred. And so in terms of, our expectation on when, if it could come, we're not in the guessing game. We're not entirely sure, but from the different variables and indicators we're reading, possibly, at some point next year, later next year, or possibly sometime in 2024. Now, this is a chart which I wanted to show everyone, which is why we believe that when or if we encounter that recessionary period, we think that it could be more mild than the past couple of recessions that we've seen. And so just a reminder on the past couple of recessions, one is the COVID recession of 2020. The other was the Great Financial Crisis. Those are two of the three worst recessions that we have ever had, going back to the early 1900s. But if you look at other recessionary periods, they're generally ones that are not deep as cuts, and they're generally not as protracted, at least as far as the Great Financial Crisis is concerned. And so this is one positive indicator that gives us hope that if we do encounter a recession, it should hopefully be of a more mild nature like we've seen historically. And so if we look at the Federal Reserve data as of the end of the first quarter, U.S. households held $17.9 trillion with a T in cash and cash equivalents, which is up a bit from the fourth quarter and much higher than $13.7 trillion that they had in the first quarter of 2020. Indeed, before the pandemic, U.S. households never experienced anything like the increase in cash they've experienced over the past 2 years. And this remains true even after adjusting for the run-up in inflation. And so I think this chart also helps explain where we're at now and the fact that the prices of goods and services have gone up so significantly over the past year, year and a half, but folks still continue to spend at a good clip. And the reason for that is, as we're seeing right here, they have more cash on hand than at any point in history, which also gives us the hope and the belief that if the economy does start to slow down, people do have that cushion already built up, so they are able to maintain reasonable spending. And as a reminder, the US GDP, about 70% of that is associated with consumer spending. So making sure that the consumer is in good health is paramount, because that is the biggest cog, in this machine to keep it going forward. And just to add on to the point I was talking about before in terms of the cash on hand and having that cushion, what we're looking at now is a graph which shows the average consumer's debt payments as a percentage of their disposable income. So what that means in English is, of every paycheck you receive, what portion of that must go to required debt payments, mortgage, car, student loans, credit card, whatever it may be. And what we're seeing here in the second quarter of 2022 is that it's at roughly the lowest point, since we've seen since the 1980, so roughly 40 years. So this also gives us the belief that if we do start to see more layoffs, if folks' salaries and other pay increase does start to come down, that they've built up enough in terms of cash reserves to make sure that their financial house is in order, but to continue spending so we don't dip into a long, protracted recessionary period. So we would be remiss if we didn't make a quick and brief comment about the midterm elections. Going to show a chart here in the next moment, which talks about performance versus over varying periods of time, first half, second half of the year. Now, we are not making any predictions on which party is going to win. We're not giving our opinion on which party we think, has better ideas or anything of that nature. We would just caution everyone that it is not wise to try and invest based on political belief. So now let's take a look at the chart here. And what we're looking at is how US stocks have performed across different areas of the election cycle. So the bottom two bars are related to all years. First two are the third and the fourth bars here are presidential election years. And the one that is dotted here in the red shows midterm election years. And so going back from 1926 to 2022, what we find is that in the first 6 months of that year is generally the worst 6 months of any period, throughout the entire election cycle. But in the last 6 months of midterm election year, it's generally been more positive. Now, we are not showing this chart to indicate that we absolutely expect the market to go up. This is more to illustrate that poor performance during the first 6 months of a midterm election year, is fairly common. And in fact, it's the worst. And, over the second half, the market does have a tendency to vastly improve over what had happened there. So now we're going to be talking about investing principles and strategies. And this is really going to be a focus on long-term and how we put ourselves in terms of the best chance of success over time. So one strategy that we've talked about for many, many years now and will continue to talk about is dividends. So what we're looking at here is a graph of how dividends of the S&P 500 have grown compared to inflation. So what we're seeing here is the light blue line is the S&P 500 dividends, and the gray line here is what we're seeing in terms of inflation. So since 1957, dividends have grown by an average of 5.7% per year, which is more than 2% above the rate of inflation. This was true during high inflationary periods of the 70s and the 80s, where you can see inflation was almost 6.25%. And this has also been true during low inflationary periods, such as the last 3 decades, where we saw inflation about 2.5%. And so, as we've discussed as well, there are 3 main asset classes that you can invest your monies in. There is cash, which we know earns practically nothing, and inflation eats that up. There are bonds, which over time have proven to be a decent hedge against inflation, but by far and away, the best inflation over time continues to be stocks, and we have no reason to believe that the future will look all that much different from what we've seen in the past. And so this is just to illustrate the power of how being invested in stocks over time, really has proven to be a great inflation hedge. Next, what I wanted to take a look at is how stocks have moved in relation to earnings. Right now, we are in the midst of the earnings cycle for the second quarter of this year. And so we'll be following that information very closely, because as we have seen over time, the S&P 500 index does follow earnings. Now we can see that these two graphs are not perfectly aligned. They don't overlap each other in every single instance. The index goes up above and below the earnings per share, but over time they follow the same general pattern. And that is because when you invest in stocks, you are a part owner in a company, which means that you are partly partly own some of the profits that a company is generating, and thus, increasing the enterprise value of that particular business. And so as the profits continue to go up, it would make sense that the enterprise value would also move up in turn, because in the short term, the market is a voting machine. In the long term, it's a weighing machine. That is exactly what this chart is meant here to illustrate. That it's easy to get lost in a lot of the noise we're seeing, but following the earnings and the earnings trajectory is generally one of those fundamentals that we're very, very focused on. So this is another chart that we wanted to show to give an idea as to the overall history of what a bull market has looked like versus a bear market. So if we focus here in this top left-hand corner, we could just look at some of these statistics. So if you go back to 1942, the average bull market has lasted about 4.4 years with an average total return of 155+%. And the average bear market has lasted a little less than a year and has gone down roughly 31.5%. And if you just look here on the graph, you can just see very anecdotally that bull markets are much stronger and longer, and that bear markets are significantly more shallow and shorter in history. And another thing that I want to point out, because it's easy to forget when you are in periods like this, is look at how many times we've experienced a bear market since 1942. More than I can, count in a quick look. So I'm going to say double digits. And so we have encountered periods like this in the past. And if you look at the graph, every single time the stock market has pushed beyond, where it was before that initial drop. And so some of the most dangerous words in investing is this time is different. So we're not going to use those words. And we have the strong belief that the U.S. economy is still one of the best places to start a business. It's still one of the best places to attract the smartest and best talent in the entire world. So we are as optimistic as ever. And I know when you're in this dark period, you're in the fog, it's hard to see the light at the end of the tunnel, but sort of zooming out can really help give us some context of, okay, we've been here before, we'll get over this. And so this is another point of perspective. This is a chart which shows the worst quarters of the S&P 500 going back to 1926. And what I highlighted here in yellow, and hopefully you're able to read that, that was the second quarter of this year, which was down a little over 16%. And so you think this year has been volatile, but this chart is to illustrate that it's been volatile to a truly historic type of scale to start. But as we look over all of these periods, over the 1, 3, 5, and 10, if we exclude 1930, which was the Great Depression, as well as 1929, and I guess this period even here was 1930, there has only been one period, since the 30s and 40s, where over the following 1 year after the worst quarter performance, that we have not seen the market be positive. And then you can see that those statistics get even better as you go farther out, 1, 3, 5, 10. Now, again, we're not saying that 1 year from the end of the second quarter, the market will absolutely be up. But if we are looking at history as some indication as to what has happened in the past, I do think that it is sort of a positive sign that the market has flushed out everything that it needed to, and we may still be in the flush out period. But again, the market is resilient, and the market, will bounce back at some point. And so this is another, again, trying to zoom out, focus on the bigger picture of things. This shows you the probability of positive returns for the S&P 500 going back to 1937 over various time frames. So as you can see on a daily basis, the market is only positive a little over 53% of the time, which is a coin flip. And as we are programmed as human beings, losses hurt us more than gains. And so when we look at the market and it's a coin flipped on a given basis, those losses are going to feel like they're happening so much more often. They're going to feel so much worse. But if we're not focusing on the negativity and we're not looking at the accounts on a daily basis, and we zoom out over these longer and longer periods, you can see over a 1 year time frame, it's up over 3/4 of the time. 3 years, 87%. And if you zoom out and farther, 10-year period, it's 97%. And over every 15-year period in the market history, the market has had a positive return. And so this is another example of why it's important to not get too focused on the trees and really look at the forest, and again, not get lost in the fog. What we're looking at here is if $100,000 was invested in January 2002 and all the way through the end of last year. And as you can see, that if you had stayed invested, the money would have essentially gone up 6 times. If you had missed just the 10 days over that 20-year period, you would have experienced a little less than half of the return had you stayed fully invested. And had you missed the worst or missed the best 25 days, you know, your investment is just a fraction of what it could have been, roughly about a fourth. And so this is a great statistic here in this yellow bubble. Over the last 20 years, 24 of the worst 25 trading days were within 1 month of the 25 best trading days. So the best analogy that I've heard to describe this phenomenon is rain and rainbows. You cannot get rainbows unless you have rain. And so generally speaking, the worst days are very closely aligned with the best days, and no one can accurately predict consistently over time when those worst days are going to happen or when those big bounce backs are going to occur. And when we've seen historically, when the market does bounce back, it happens fast and it happens very strongly. So it's very important to just be focused on the long-term goals. So in summary, these are the biggest takeaways that we want you to walk away from the presentation with, in addition to the actionable items Jordan's going to be finishing up here with in just a moment. The market is focused around uncertainty with inflation and interest rates. And I guess I could have also put uncertainty around supply chain issues and the war. The more clarity we get around any of those topics, but primarily inflation and interest rates, the better that's going to be for markets in terms of providing more direction. U.S. companies are still profitable and looking to hire. They are paying out more in dividends in the second quarter than at any point in history, and they are looking to grow. So inflation is biting into profits, but they are still profitable, looking to hire, looking to grow. And the consumer is in a strong financial position. So if and when we do encounter that recession, we do think that it should be more mild than what we've seen, at least in terms of the COVID recession and the financial crisis. And then last, but certainly not least, focus on the long term. It's very easy to get caught up in the day-to-day, but focusing on your long-term goals is the only way to achieve success over time. Now let me turn it back over to Jordan to talk about some ideas you should be considering.
All right, thank you so much, Sam. Let's jump right in. Ideas to consider. If you don't have a pen and paper, please grab a pen and paper. I would encourage you to jot these down. This is where the rubber meets the road. Here's some planning strategies, starting with the Roth IRA conversion. We think that this strategy makes a lot of sense given the fact that market values are down. And here we are, the end of July, mid-year, and there's some planning opportunities. When considering an IRA, a Roth IRA conversion, let me be clear, this is not for everybody, and we do not recommend this for everybody. You have to look at the numbers to see if it makes good economic sense. We have software, we have some tools that we can run some numbers, do a calculation. It's not all or nothing. So you can do a partial Roth conversion and move some of the monies over a period of time. The second idea here is the QCD. The QCD is a qualified charitable distribution. Now, this would apply for someone who is taking required minimum distributions. Those are RMDs. If you're below the RMD age, this does not apply to you. This is a way that you can take money out of your retirement account and not pay tax and have it go to your charitable organization of choice. You can do as little or as much as you want. That's a year by year type of thing. And again, this is something to strongly consider. The third item is called tax loss harvesting. This is an opportunity where we at Dechtman Wealth Management have been very proactive in helping our clients take some tax losses to offset any potential gains. And we want to continually be vigilant and proactive in helping you, our valued client, in minimizing the tax impact. Please know that we are working incredibly hard throughout the year thus far to focus on ways to add value. Tax loss harvesting is one of those ways, and we would encourage you to come in so we can talk a little more about that for you. And the last item here is dollar cost averaging. This is where you may have some money in the bank. Sam talked about the enormous amount of money in the banks and credit unions. And if you're scared, you're nervous, we get that. This is a strategy where you can dip your big toe in the water and you can invest monies over a period of time, little bit each month, and it could be any time frame that you are comfortable with, 3 months, 6 months, 12 months. But this is a way that over time, you can ease your way back into the market and take advantage of the recovery when the recovery does happen, and it always does. So this is the time where we'd like to encourage anyone to ask questions. If you do have a question, please type your questions in the Q&A box at the bottom. And while you're doing that, I just want to say, and we can come back to, let me just say this. If you haven't been to visit here with us, please give us a call, send us an email. Let's schedule a meeting. We can do this in person, over the phone, Zoom. It's really important that we sit down and go over things on a regular basis. Sam, you want to take the first question here?
Yes, yeah. All righty. So this question is related to the war, and the longer that it continues to go on, what are the implications? So that's a pretty multifaceted question. That's a little difficult to say with too much certainty. So I will put it, in this way. We have a great chart, and we should have maybe included it in this presentation, that looks at all past conflicts. It looks at all past wars. It looks at different assassinations. It looks at other terrorist events. It looks at other horrible periods in time. And what we have found is no matter how long these conflicts continue to last, they generally do not have, in most cases, too many long-term consequences as far as the market is concerned. In terms of how long this conflict is going to last, that's really anybody's guess, and it's hard to fully know the answer to that. But it kind of, our idea that we don't know how long this is going to last, and it may be going on for an indefinite period of time, really leads us to the idea that we believe that the United States is the best game in town when compared to other parts of the world, which is why we have started to, but at the beginning of this year and even part of last year, moved more monies back internationally, back here to the U.S.
Thank you. And I would just add one thing to that. Sam made a comment earlier in the presentation about are trimming back international positions. We feel that, yes, the US is the best game in town. You can rest assured that you don't have any investments in Russia or that general region. We are very, very focused on managing risk. Okay, we have, boy, oh boy, we have time for one more question. And the question is from Bob, would you consider tips, why, and how long? So this is a great question, Bob. Thank you. So tips are short for Treasury Inflation Protected Securities. There is a government bond that has recently become available. They are called inflation bonds or I bonds. They're very interesting. They are tied to inflation. They are limited to $10,000 maximum, and that is on a annual basis. While it's very attractive at the moment, as inflation is high, historically, we're not exactly sure that it really is a great place to be. I would say as an alternative to consider would be the dividend strategies that Sam spoke to specifically. And again, more importantly, how it fits in with your personal plan. And that's a individual kind of situation. So that's the kind of thing we'd ask you to talk to us personally so we can make a specific recommendation.
And I just want to add one more point to that, Jordan. So the TIPS, which is Treasury Inflation Protected Securities, are supposed to protect against inflation, but they do not protect against increases in interest rates. So even though inflation has been high, TIPS are down, and they're down about double digits this year. So it's not as if when inflation goes up, these things are definitely positive. So it's a little bit more complex than that.
Absolutely, absolutely. All righty. Well, we're gonna wrap this up here, and we want to thank you all for taking time to be here this evening. We would encourage you to schedule a review consultation today. Give us a call, send us an email. Our phone number 303-741-9772. You can email us. You can go to our website and schedule an appointment. We are very grateful and appreciative and value all of you so very much. And we want to say thank you again and hope to see you real soon. Have a good evening.
Thank you.